Sinomania. Seng 30,000. Is there an upside to inflation? And commodities boom. Markets on mainland China are closed for the National Day holiday, one of China's golden weeks, a week-long national holiday. Trading ended last Friday with a bang. The Shanghai Composite hit a new record high and closed September 28 over 5,552. The CSI 300 index also hit a new record and reached 5,580.813. In Shanghai, B shares finally bested May's performance and won back lost ground from the tripling of the transaction stamp tax and closed September 28 at 367.35, a new record. Meanwhile, Hong Kong's markets remain open and there is quite a rally in the Seng index that reached a new record high just under 28,000 on October 2nd, but is back below 27,000 today. The Seng has exploded since September, and there are many reasons behind the new bull run. Certainly cash coming from China's domestic markets is playing a part, but the bigger reason may be the interest rate moves of the United States Federal Reserve, since the Hong Kong dollar is directly pegged to the US dollar. In fact, some analysts believe this signals a long rise for Hong Kong equities, and we may see the Seng go to 30,000 or higher. Meanwhile, Chinese regulators are constricting the flow of liquidity into Hong Kong by delaying direct retail investment by individual Chinese investors, and a new rule announced this week aimed at preventing Chinese companies from issuing stocks simultaneously in Hong Kong and on domestic markets. The IPO report will be back next week. The big talk of the week is the upward trend in prices of nearly all commodities all over the world. The Commodities Week conference going on this week in London and Dubai has plenty of talk about the amazing global commodities boom that shows little sign of abating. Speculation is back that oil may reach $100 a barrel as early as 2008, confirming calls made last year by George Soros and Goldman Sachs, among many others. Jeff Rubin, chief economist at Canada's CIBC World Markets, is the latest to make the pronouncement. The warnings of two big reports on world oil and supply demands that I discussed in webisode 24 of this program back in July confirm this view. Indeed, some forecasters believe the world may be in a 50-year commodity boom, and recent prices for everything from lead and copper to wheat will give investors a lot to think about. One thing appears obvious: commodity values are affecting prices everywhere. While globalization may trend toward deflationary impact, the current reality is that inflation is back and going up. Most countries today remove food and energy prices from official inflation numbers in order to dampen the psychological effects of high inflation. Unfortunately, almost everyone is noticing that everything they buy is becoming more expensive everywhere in the world. The real inflation rate in China is probably getting close to double digits, and in the USA, perhaps as high as 8%. Inflation rates like this will have an impact on the Chinese currency, and already there are signs that the yuan may appreciate more than expected. Reading the tea leaves from the last bank regulators' meetings in Beijing, Morgan Stanley economist for China Qing Wang believes that yuan appreciation will accelerate faster than expected, and that will mean higher prices for Chinese goods. The Blame China crowd is already complaining that China's next big export will be inflation. The fact that the inflation is born in a United States mired in recession is beside the point. Increasing the cost of Chinese goods will also be due to the quick efforts Chinese regulators and manufacturers are making to improve quality and safety of Chinese goods in the wake of the toy and tainted food crises. Just today, more big headlines about Chinese toy recalls. Despite the apology to China from Mattel and their admission that the toy crisis was a design and oversight problem on their end, the U.S. Consumer Product Safety Commission continues to be the blunt weapon of choice to confront the China trade challenge. I'll see you next time!
This conversation can serve no purpose anymore. Goodbye.